A very good morning to everybody. It is genuinely a great day for our institute to host one of the most legendary investors India has seen, Mr. Bharat sir, as part of our Stalwart series at Finacle Institute. With more than 2 decades of industry experience and star-studded education qualification, Bharat sir needs no introduction. Most of you guys have already studied from Bharat sir's publications as we continue to do so till date. Without any further ado, sir, the stage is yours. We would love to continue to learn from you. Over to you, sir.
No, learning. Thank you, Shailesh, for the kind words. But the learning is always mutual. I learn from my young colleagues as much, at times even more than what you pass on. So learning is forever, and in life in general, but in investing in particular, it is even more so. So, and then we can leave the remainder 40 minutes for open forum.
Yes, sir.
Okay. Let me talk on, let me gather my thoughts around what I see as some of the key topics. So one topic could be what investing is. Second topic can actually be that what investing is not. Can you just give me one moment, please?
Of course, sir.
દિલનભાઈ હું એક કોલ પર છું કરું તમને પછી 1.5 કલાક લઈને હા start. So what investing is not is equally important to probably share ideas on. What entails investing? Or in other words, what are the methods and principles through which you want to draw a philosophical framework of investing? Fourthly, why investing is perhaps very different from many other professional pursuits one may have in life. And to that extent, investing remains a bit of a specialized activity. And therefore, not everybody really may or may not have necessary apparatus and the mind frame to be in the investing activity. And the other aspect would be sorry. What can be among the most important objectives of good investing all about? So let me start with that last point, probably the first. I would say investing fundamentally has two very vital pairs of objectives. And both are twin pairs of objectives. One is a principle of absolute and relative as a contrast. Second is a principle is capital preservation and capital appreciation. And both the pairs are vital in terms of how you go about viewing the investing. Therefore, if we say capital preservation doesn't mean day-to-day, moment, some techno algorithms or software to try to protect your capital at every moment or every day or every week or a month or whatever. These attempts are very popular There are a lot of people who try to using sophisticated technology and many powerful algorithms have tried to do that or sought to do it. Barring Renaissance Capital, which is phenomenal, who Jim died recently, just about a month back or so. A phenomenal guy, I would say, though I don't. I don't understand the philosophy with which he has run it in a way that I can't run it myself. But his incredible intellect and incredible record that he has built is something, no matter philosophical disagreement, but is something which is something I bow before and I have a deep, deep respect for. But barring some exceptional individual like Jim, these attempts to preserve by short-term gambits are not usually found successful and certainly not found to be predictable success. Some cases success may occur, but it may not be predictable. And to that extent, that success is not particularly valuable. The preservation, when we talk about, is basically having mental makeup, having a strong philosophy, having stock selection methods, having appropriate guardrails, and a set of discipline tools to ensure that you arrange your investment affairs in such a way that over a meaningful period of time, you materially eliminate a probability of a permanent loss of capital. Permanent loss of capital is a huge damage, not just in the portfolio if you incur, but psychologically it can weaken you very badly. And therefore it results in a not only first level of error, but also second and third level of errors, whereby your future ability to deal with the challenges gets impaired. And therefore avoiding permanent loss of capital is a very vital idea. The permanent loss of capital essentially, to my mind, comes from two simple ideas: quality and the margin of safety. When I talk about quality, I mean quality of management, quality of the business, and the quality of the financial position of the firm that we are talking about. And all three aspects are important, of which the first two are hygiene factors, fundamentally enabling factors. Third one is a maintenance factor, the quality of the financial position. That works in conjunction with the first two, but independently itself, it's not a source of value creation. Therefore, when we talk about quality, which in my opinion is the first principle of investing, if I would say the first principle objective is capital preservation, first principle of investing to my mind is the quality. And quality of both management and quality of the business. Very, very few businesses anywhere in the world, not just in India, really have a character, really have tenacity, resilience, and depth to be able to create meaningful value over a material period of time. Most others are either shrouded in mediocrity, decimation, if not destruction. And therefore, probably more than 90% of the businesses anywhere in the world of all kinds, whether private equity, venture capital, listed businesses, startup types, whatever kind of businesses, more than 90% of the businesses simply do not have a character to be able to create value. And therefore, ability to figure out them so that you can focus on only the remaining single digit percentage of the businesses is a very vital part of investing. Remember, I mentioned what investing is not. And one of the important filters is what not to do. And therefore, ability to remove something is a source of enabling, because then you can focus on what remains. If you kind of filtered out, uh, the sand, then what remains, the gold particles, is what is important that you can focus on. Quality of management, to my mind, is a very deep idea, and it is not something that you figure out in one go instantaneously. There is no eureka kind of immediate moment. Even if eureka moment actually is a culmination of a lot of deep thought over a period of time, which went into the mindset behind by Archimedes, and then he suddenly ran out naked out of the bathtub. When the idea really struck him, when he correlated many, many things together which were going on at the back of the mind. So serendipity or eureka moment are not accidents. It's a culmination of a lot of good things that happen at the back of the mind. But what I'm trying to convey is that management quality is not something that you figure out in one go. It takes its own time. And therefore, one has to be patient, one has to be observant. Capital allocation, capital distribution, resilience, adaptability, skin in the game, governance, ethics, execution capability, foresight, tremendous work ethic, ability to see through the short term and focus on the long term, the eventual reality, are all very, very vital parts of all that can be summarized as management quality. And all of each of these aspects probably takes a material amount of time before you can come to the conclusion. Similarly, quality of business. As I mentioned, very, very few businesses have really character to create value. And therefore, again, it requires a mental makeup. Can we request participants to be on the mute? Therefore, very few businesses really have a capability to create any meaningful value. What works, what are the underlying mechanics and the factors are very vital to understand. Each of these subjects itself can take a half a day. So I can't possibly spend on quality of management and quality of business a half a day each. But broadly, let me put the perspective that both are very critical pillars of what is essential, what is at a foundation of what is a good investing. And without that, good investing is something on a sustained longer term basis is not possible. On the contrast, at times bad businesses seemingly seem to create a lot of value. There are enough instances of how terrible businesses which have resulted in utter destruction, but have went up, they have gone up during a particular phase of irrationality or madness. They've gone up by 100 times, 200 times, 500 times, and therefore it gives an illusion of invincibility, and therefore it results in you putting away your intellect and mind aside and following what may be popular or what may look very powerful. Therefore, do not underestimate that what bad businesses at times can do. But the destiny of both good businesses and bad businesses is predetermined. Good businesses eventually will rise in the value, but in between it is entirely possible that it may go through series of falls and rises before it shows the eventual ascent. Bad businesses have to have a path of descent eventually, no matter what. But in between, there'll be many phases and moments when it will have a very blazing life. Even if life eventually will flicker away and die, but it invariably even the bad businesses go through the moments of great exhilaration and life, where they blaze and not merely shine. And therefore, what can go wrong, even if you understand things well, is during moments of weakness, you can give away a good business. And during equally a moment of weakness, you can end up actually lapping up bad businesses. Out of the two errors, both errors really punish you. When you surrender away good businesses, because good businesses by definition are few, and therefore you need to replace it with one more new good business. Bad businesses are in plenty, and eventual destiny of a bad business is usually a terrible outcome. Rarely one is able to get away with the murder. Bad businesses is like a murder. Sometimes some very clever ones, murderers do get away with that. But you shouldn't be banking upon a probability of committing a sin and getting away with it, where the probability is actually rather low. Therefore, remaining very disciplined is very vital part of investing. Intellect is important, but not necessary. Important is thing that you need to have, but is not enough in itself. And a very important element is the discipline. And discipline, not to not to feel tempted or not to feel pressurized to surrender away a good business, and equally not to feel tempted and greed to buy a bad business. The second aspect of the preservation is the margin of safety, but I'll take it up in a while. Therefore, quality is a very, very important source of capital preservation. Capital preservation itself is, in my opinion, the first principle of investing, and quality of that business and management and the financial position is again the first principle within the first principle. The second idea is the capital appreciation in the same set of objectives. You don't buy merely to preserve capital. You invest in order to grow. And therefore, capital appreciation is a very, very vital idea, because without that, there is no real opportunity. Nothing, even in nature, remains static. If something remains static for a while, it actually begins to diminish, it begins to diminute, and eventually it decays and declines and dies. Therefore, even in nature, nothing remains where it is. In very long period of time, aeonic terms that you measure universe, every physical phenomena, every physical object degrades and reduces if it just remains where it is. Therefore, growth is the elixir of life. And growth is a fundamental factor which enables capital appreciation. Therefore, many times people debate about cheapness. Cheapness in itself is not a virtue. And cheapness is unfortunately defined in many confusing terms. In the marketplace, sometimes cheapness is defined as low price earning multiple. Sometimes it is defined as low price to book. Sometimes, very foolishly, but it is defined as low price per share. Usually, no meaningful investor is carried away by low price per se. But a lot of good investors do fall for time to time, or at least sometimes, for cheapness, mathematical cheapness. is really a foundation of what is value. But value is a much, much larger term than just the mathematical cheapness. And therefore, if your model of valuation is only mathematical cheapness, chances are extremely bright that you will fall for that trap not once but many times with huge amount of confusion and huge amount of damage that it will cause. Therefore, when we talk about capital appreciation, we are essentially talking about two important aspects: growth in the future of the earnings, rather cash flows, therefore not merely top line, but also bottom line, but really speaking the cash flows. A meaningful growth, a durable growth, and the predictable growth are very important foundations of capital appreciation. The second other part of that capital appreciation is the quality of growth, the moats, the seeming invincibility factors around the business, ability of a business to ward off challenges, culmination of all of that in capital efficiency, return on capital employed, return on equity, and many other factors which make business durable, all are subsumed within the quality of growth. The capital appreciation is function of both the growth and the quality of growth. You need a decent, predictable, reliable, durable growth of a variety, which is at the root of value creation, but you also need a sound quality of that growth. Hello? The capital preservation and capital appreciation together, just a moment. તમને કરું એક call પર છું, 1 કલાક. Yeah. Capital preservation and capital appreciation together form one very vital pair of objectives. The second pair is absolute and relative. In my opinion, the purity of investing is all about absolute. That fundamentally you buy a business or make an investment in order to create value, an absolute positive compounding value over a period of time. More often than not, the investing is viewed as a kind of a duet, or a duel rather, not duet, my apology. Like people throw their heads in the ring, like a gladiator. And whether you are trying to fight with the market or you are trying to fight with the other peers in the game, while a relative part stems from fundamental instinct of survival of Homo sapiens, but really purity of investing is all about absolute. The beauty is that when you focus on absolute, the relative happens to be a part of it simultaneously. It comes out as a derived objective out of it, as a residual outcome. The the two pairs, the pair of preservation and appreciation of capital, and secondly, returns which are absolute as well as relatively superior, are the two pairs of important objectives which completes the kind of fundamental philosophical objectives behind investing. Therefore, from the purity perspective, I would say desire to generate absolute, positive, healthy, compounding returns over a period of time without any fight or a dispute or argument with Mr. Market is a very fundamental objective of investing. But the beauty is that is akin to driving, looking at the front screen and not getting distracted by what you have left behind. But relative investing often is that variety where you are trying to look behind. You're trying to look behind, therefore you try to drive from instead of windscreen, you try to drive from a perspective of a rear view mirror. And rear view mirror driving is prone to accidents, if not worse. And therefore, world generally thinks in terms of the relative because it is inherent in the Homo sapiens DNA as a means of survival. But really worthy objective is absolute. But a healthy absolute automatically brings about a relative superiority over a period of time, and therefore focus on healthy absolute in turn brings about superior relative, and the two together complete the pair. I've spent deliberately significant time on these pillars because the philosophical pillars in turn actually give you indication of the kind of factors which go at the root of what is value creation. You need a good management. You need a good business. You need a large size of opportunity so that in the hands of a good management, a large size of opportunity can convert into a healthy outcome, which is growth in future. Not merely of the top line, not only confined to bottom line growth, but also that of cash flow. While growth in itself is elixir of life, it is not enough in itself. It needs a very powerful support of the quality of growth. Much like, I would say quantum of earnings growth is important in itself, but quality of growth is even more important. Both are vital, but maybe quality of growth is little more than the quantum of growth. Therefore, your focus at all the time is to ensure a very healthy combination of the two. These, along with the capital efficiency indicators, moats of the business, allow you with a healthy valuation model, which is both art and science. It is not only science. And the two together allow you to convert all these knowledge into some kind of a focus or some kind of a conjecture or some kind of an opinion about what you believe is the value of the business. Value is not a mathematical number. It is not a certitude. It is not a gospel truth. It is an intelligent opinion. Intelligent opinion which has taken into account various things, pluses, minuses, and therefore it indicates a degree of probability. Therefore, ability of an investor to make an important judgment on valuation, we are merely talking of greater capability, which results in superior probability of making sound valuation judgments over a long period of time. And it is probability which is important because no matter how good you are, but that probability, it remains a probability. It doesn't become binary 1 or 0. Investing is not a binary game. It's a movement along a continuum of probability movement, and your skills and ability and mindset as an investor is to optimize that outcome of the probability that you play enough number of these judgments and a superior probability will turn out to be successful. And that is what you mean by that valuation opinion, and not a certainty or a certitude at any point of time. Secondly, valuation is evolving idea, is not a static idea. Valuation is not at a point of time. While at a point of time you have an opinion, but it is a forever evolving idea with the new insights, new understanding, new data points, new judgments. You may alter the valuation opinion, and that is part and parcel of the game. Third comes from the adaptability. There is a very thin line between arrogance and conviction. Conviction is vital and indeed required. It is an essential, I would say. Without that, you can't play the game of investing. But equally, when it no longer remains conviction and becomes actually kind of arrogance, is where a thin line needs to be drawn. And that thin line is often a source of grief to even talented investors, where no longer the view remains opinion, but it becomes like a gospel truth in the eyes of the beholder. That's where markets actually give you a blow and make a mincemeat of the individual. Therefore, valuation is an opinion. It's not a mathematical certainty. Secondly, it is not a snapshot. It's an evolving idea. Thirdly, it is a very complex interplay of understanding and intellectual capability, but at the same time, sobriety, humility, and ability to understand that there is only so much you know. And beyond that, there are so many things that you do not know. And no matter how much you know, and no matter how much you have accumulated over a period of time, at any point of time, there is still only so much you will know. And there will be a vast arena of what is beyond, which you may or may not know, or you may still need to learn to know. Ability to recognize our own failures or our own frailties is a very important source of a risk control in investing, because it will not let you get carried away by your opinions way too much. At the same time, conviction is essential. If you are able to, if you are a type who will bend at every, if you are like a straw, which with every gush of wind you will bend, then that will not allow you to deal with the machinations of the market. Markets are not designed to make you succeed. Markets, in fact, are designed to make you fail. Markets try to play on your weakness, and therefore, markets try to trap you into psychological weaknesses, which means when unworthy things go up and attain a great valuation, markets are actually trying to trap you psychologically by falling for that trap and suck away your capital into bad businesses at bad prices. And therefore, that is a recipe almost of a short variety of a disaster. The second aspect, equally punishing and painful, is when markets trap you on a lower down, when good things fall and you have a heart of chicken and inability to participate even when things are cheaper than the value and leave you a good margin, is a point at which you are actually surrendering, and you do not have an ability to optimize on the opportunities. So therefore, whether markets trap you with permanent loss of capital by making you commit to a bad business, and even worse, at a bad price. Therefore, if you invested in DSQ software at a price of some 3,000 in 2001, and price became zero in a matter of just a couple of years. So permanent loss of capital. Pentaphores of the world, pentamedias of the world, even many such fancy ones around 2000, 2001. Some infrastructure businesses and construction businesses in 2004 to 7. Many other large names, mid-sized names, which committed huge amount of errors, and they were darlings of the market, have lost 95%, 97%, 98%, 99% over a period of decade and more, and therefore there is no hope in hell ever to recover. Therefore, markets are designed to fail. It is your duty to succeed. Markets have no need to favor you with returns or appreciation or to make you wealthy simply because you have allocated some capital to the markets. It's your duty to earn returns. It is not the duty of the markets to make you earn returns. Therefore, market is a place of landmines and booby traps. It requires you to have skills to figure out which are the booby traps and which are actually the virgin land. And therefore, at every step, you need to be watchful, careful, and find your way. There is no time, there is no place for arrogance. At the same time, you have to make a judgment and believe in that judgment and act upon it in order to avoid those landmines or booby traps. Therefore, investing, you will find, is a typical duality. You talk about price, but what is more valuable is value. Price is merely a dancing number at a point of time, but lodestar or the guidance star of investment returns really is the value. You talk about quantum of growth, but quality of growth is actually even more important. You talk about a lot of science is a part where earnings per share, profits, and projection of some of these numbers all look very mathematical and certain, but it is actually what is art rather than science. What is English rather than mathematics often is more important part of investing. The similar pair is return and the risk. Return looks very tangible, very solid, very deterministic, but it is the risk management which is the source of earning returns over a period of time. Returns are actually a derivative of the risk management. Quality quantum is often a derivative of quality. Valuation price is a derivative of value and not the other way around. But more often than not, we try to judge value from price rather than infer a sensible price from the value. Investing, therefore, remains art and science of valuing value rather than valuing price. And therefore, ability to value the value is a very integral component of what all are the vital aspects of good investing. The yin and yang of investing, the tangible versus intangible, quantity versus qualitative, value versus price, return versus risk, art versus science. Many of these pairs, apparently contradictory, but are an integral yin and yang of investing, much like in life. Life is never a straight line. Only we delude ourselves in thinking that way. Investing in a spiritual way is similar. It is the yin and yang. If you appreciate that idea, then your mind is at peace while dealing with the challenges. That yin and yang balancing doesn't allow you to get arrogant in your success. and doesn't make you feel defeated in your temporary failures. And therefore, it allows you to bounce back and recover, because every investing journey will encounter those challenges. There will be times when you may be right, but markets may be perfectly determined to make you feel a fool. And there'll be times when you do perfectly foolish things. But markets at that time may make you feel like a genius by raising the price of such bad things high and higher and highest, till you surrender all sense of discipline and throw all caution to the winds, and result in a deep, deep kind of a body blow. Therefore, this appreciation of yin and yang is very vital idea. An ability to carry two contrary things simultaneously in the head without making your head into a mashed potato is a very vital skill that you need in investing. The other skill which is vital is an independent mind. Mind like a sponge which is able to soak a lot of things from the others. At the same time, having rationality and objectivity to constantly evaluate all the inputs that you receive, including from the good sources, and not accept anything blindly. Therefore, a mind which is critical, mind which is objective, mind which is independent. Independent mind is not necessarily a contrary mind in everything. Contrarianism or contrary investing is a very powerful idea. And usually it is the contrarianism that is an intellectual foundation for future investment success, but doesn't have to be. It is important, but is not always the case. There are times when good things may get disregarded, or more often than good things being disregarded, more often what you find is good things can be undervalued for a prolonged period of time. Equally, there are times when bad things acquire currency, and not only they go up violently, where it results in abandoning of all your judgment, all your rationality, and surrendering to that emotionality. Markets are all about the rationality, but human beings are emotional, and therefore, at any point of time, market moment represents a mixture, a curious mixture of rationality and emotionality. The two are twin pairs, much like other twin pairs that I mentioned. Depending upon whether rationality is higher in proportion or lower in proportion, may result in overvaluation of good businesses or paying undue regard to the bad businesses. And when rationality is downbeat on a pessimistic side, it may systemically result in disregarding the opportunity of value, where values are actually prices are much cheaper than the value. Therefore, your ability to distinguish between the yin and yang, the rationality and emotionality, and therefore digging it out, that how much of the price today is influenced by emotionality rather than rationality, and real hokayantra, or the lodestar of guidance for the future, is the value. Value is what rationality is, but price at a point of time could be a very difficult mixture of both rationality and the emotionality. Over a period of time, the role of emotionality reduces and role of rationality increases. Therefore, price gravitates more towards rationality, which is value. But once again, a new set of emotions emerges. that new set of emotions will again result in divergence of the price from the rationality or the price from value. That convergence and the divergence, like a alternating a sequence that you see mathematically in a rhythmic pattern, will carry themselves out like a Fibonacci mathematical sequence over a period of time. Time to time, prices tend to go up compared to the value or go down. Extent of its divergence will depend upon extent of emotionality. Once again, after a point of time, it will reduce that divergence, achieve more convergence. Again, a new set of factors and new sequence emerges, and the sequence goes on forever. My one last piece on that rationality and emotionality piece is concerned, or the rather the yin and yang factor is concerned, is an ability to uh, 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 really hold your head well and not surrender it in the crunch times. Intellect is necessary, but a very poor substitute of good outcome in investing. Markets are a place where intellect is very common. By and large, most people are bright and well above the average IQ. And all that you need is well above average IQ. You don't need to be a genius. Therefore, market usually attracts people who are fairly bright. And those who are not bright enough and are sucked into the market, the centrifugal force of the market will throw them out soon rather than later. And therefore, brightness and IQ and talent is something which is reasonably common and rather a commodity. It is not a distinguished brand, it is rather a commodity. But what is not commodity and what is actually at the depth of investing are other things. It is discipline, it is character, it is temperament, and it is wisdom. Intellect is not a guarantee of any of these. Intellect doesn't assure character. Intellect doesn't assure disciplined mind. Intellect doesn't guarantee wisdom. Intellect doesn't guarantee psychological temperament to remain calm. As an investor, you are both a player as well as a referee. As a player, your emotions are involved because you are playing the game. But as a referee of the hockey game or referee of a football, he is not playing, but he is deeply involved in the game, watching from the sidelines and actually making sound judgment as to what will be the good move to make at this particular second. That detached perspective of a coach is very vital for good investment outcome. But as an investor, while you're playing the game, what you need is that detached bystander rationality, but what you are sucked away into a vortex of emotionality because you are part of the game, and as a part of the game, your emotionality is bound to come to the fore while playing the game. Your excitement, your sense of defeat, your sense of depression when you don't do well, or sense of elation. Many of these things are part of the game, but these are emotions. And the game itself, investing game, is rationality, which is what coach is doing. And therefore, how to sublimate or rather subjugate your emotionality and to sublimate your detached perspective is what investing game is all about. Final thing I'll put here, that it will be good to have in mind what can be probably good objectives to be an investor. For a lot of people, wealth is important, and investing is a route for making wealth, for riches. Nothing wrong with wealth and money. But If your primary focus is wealth and money, probably you are unlikely to succeed in investing. Good investing, no doubt, will make you wealthy and rich. But if that is the only motive that drives you, chances are you will not have that achievement of that objective, even if you have capability. Wealth is important, recognition is important, money is important, but I would still say these are byproducts. These are the scores that typically people keep, but probably may not be the best scores to keep. I think investing is a deeply self-fulfilling talent game, a game of intellectual capability and emotional maturity. Therefore, winning that game is not easy. Markets are very tough to beat, as the market is a very complex and very capable individual. Even if Mr. Market does extremely irrational an extremely foolish thing at a point of time, Mr. Market over a period of time is huge amount of very rapidly evaluating, fast churning machine which takes into account millions of pieces of data and emotions and everything and instantaneously converts into an opinion called price. You can't hope to defeat Mr. Market by having more access to info or to have a greater speed of that info or to feel that you can have some illegal or illicit or unethical insider trading or access to privileged information as a way of making returns. None of these are successful means of achieving good outcomes, but mostly people try. And because people have bright mind by and large, therefore they try more and they feel that they will get away. But intellect is not a guarantee of many important attributes. The day you understand that intellect is important, but just one of the important factors, but not everything, and other factors are much more, that is the day you really start learning. And I would say that intellectual game of satisfaction of winning against market, which is so difficult to do, is one great source of satisfaction. Second is the learning, because constantly markets make you learn and make you learn in diverse branches of knowledge. Like Hexton described in that beautiful book, latest work, all the various branches of knowledge, whether physics or whether space, whether psychology or whether economics, whether the detached art and science of clairvoyance or forecasting, but not in a magical way, in a way of disciplined pursuit of the idea of the future. The literature calms your mind and makes you kind of balance. Spirituality gives you a thrust not to get carried away by success or failure. And therefore, there are innumerable branches of knowledge that you learn from. There is not only one thing. And therefore, investing teaches you so many things that even for that learning, I would say, I would remain a lifelong student of investing more than anything else, just for the joy of the learning, because that joy is indescribable. If you assume a role of a professional investor, or you are managing and guarding your family's wealth, either way you have a trusteeship responsibility. And when you discharge that ability, then you do a great favor to the people who depend upon you. Because as I mentioned earlier, not too many people can do investing. Even if you're intellectually equipped, because most people think about the past, while investing makes you think about future. Most people think about tangible and concrete. Investing teaches you about intangible. Most people are carried away by price, but investing needs you to understand value. Most people get carried away by certainty of what they see rather than probability or probabilistic nature of a future, while that future is more valuable than certainty. Because certainty has occurred and therefore it cannot impact value. It is what will change in the future which will change the value and therefore the price. And therefore, human race thrives in certainty, but investing requires you to deal with uncertainty. And therefore, not many can deal with investing even if their IQ is very high. If you see the history of in 90s, long-term capital management, a firm which had four Nobel Prize laureates, and they created a very powerful mathematical algorithm aided by physics capability of one of those four who had Nobel Prize in physics. And yet, after 1.5 years of glorious, unbelievable results, the firm fell apart like a pack of cards. And therefore, the idea of the investing culminating into all of these put together is something that you want to appreciate. That it is not mathematics, it is not only science, but it is also art and English. And many of these factors, intellect is not a guarantee. Intellect is only an enabling factor, but not a crystallizing certainty giving strength to you. Therefore, humility, ability to learn from various branches of knowledge, and satisfaction of delivering outcomes to people in a healthy way based on your specialized ability to do so is a huge social contribution that you make. You may not always realize it that way, but it is an enormous act of contribution to the society. But you not only have to get the results right, you have to do it right too. It is not enough to get it right. It is equally important, if not more, to do it right as well. Therefore, intellectual gratification, learning, discharging trust of the others, the sheer satisfaction of constantly evolving and becoming better and better individual overall. Just for those goals, I would say investing is more than enough. But like you pursued absolute, relative becomes an automatic outcome. When you pursue these worthy objectives, becoming wealthy and getting recognized, acquiring riches is something which is an automatic outcome. I'll stop it.
Thank you so much, sir, for such a dense conversation. I'm sure we'll have to revisit the recording again to make notes of the same. But it's been truly, a very deep learning talk, which again, as I mentioned, we'll have to go back and revisit the recording to make notes. So with your permission, I would like to share a screen where we have written down few questions which we have collated from our existing students and alumni, which we were hoping to ask you, sir,
J,
in the remaining time which we have, sir, of course.
J, J. Or you can read out quickly and I'll answer.
Surely, sir. Surely,
Because
sir. I'll
I've
read.
taken 15 minutes more. So we'll have to kind of conclude little earlier than that 30-40 minutes we had planned.
No, no, of course, sir. Definitely, we'll keep that in mind. Let
Because
me read
reading
out the
this will
question.
take a time. Please, you read out and I'll quickly seek to answer.
Surely, sir. So the first question is more on the lines of what you just mentioned, that growth is, elixir of life, and capital appreciation basically depends on two factors, which is growth and quality of growth. So the first question which we wanted to ask, how do you judge the quality of growth, whether in a good or a bad business?
But the modes of a business are relatively faster to discover than the quality of management. Quality of management is tougher to gauge and takes longer to gauge than the quality of business. Both are tough, But quality of management takes more time, requires a deeper internal conversation with yourself and your ability to pick up nuances and perspectives relatively faster in order to judge the management well. Relatively, I'll say quality of management is more of an art, and quality of business relatively is more of a science to judge it. In a way, character of the business can be judged more from the return on capital employed and its durability in a mathematical term. Character of management actually is judged in a mathematical way more from return on equity and its durability. These are important guideposts, but not enough. Character of the business is something which is difficult to judge because the character of the business is an evolving idea. A character of management, which is say deeply ingrained around certain characteristics, usually monkeys, keep jumping around and don't give up that habit of jumping. Therefore, your inner character doesn't change all that much. If you've judged it and judged it well, you can reasonably forecast what is likely to be done in the future. But the character of business is an evolving idea. It's not a static idea. It evolves with the rest of the ecosystem, rest of the society, rest of the world evolving. And therefore, you have many more variables to evaluate. And therefore, it acquires some amount of constancy of a change. But that said, things like capital efficiency, ability of a business to get more out of the same resources, or ability to use progressively less resources to achieve the same outcome, ability of a business to be able to fight against the challenges of competition without getting bruised. In other words, if it is only required to do a price war in order to retain your salience, it's a bruising game. And therefore, good businesses rarely are dependent upon only capability of just cheapening the prices and ability to win a game. They usually have deep advantages, and not one, but probably many. And they keep unraveling depending upon whichever card the business wants to play at a point of time. Many of these you can compare in an industry context, but you need to appreciate for an individual business because investing is not macro. It is not about sector. It is not about a theme. It is not typically about geopolitics. It is not about macroeconomics. It's about a particular business, its value, its management, its quality and character and growth and what have you. And therefore, while macro understanding is very vital, but investing is mostly micro. Macro is probably fewer percentage, micro is a much, much higher percentage. And therefore, you want to reduce a particular business into very important critical success factor of micros and constantly track and judge. What is critical success factor itself may change over a period of time. And therefore, you need to make a note of a changing factor in a dynamic way and realign your value of a business, the conjecture constantly based on all of these. I don't have a simple answer, but there are many, many factors that go behind to create a possible method of judging quality of the business. But the beauty about investing is for a long period of time, it can keep you in a mentality of folk or can keep you feeling intellectually confused that you think you feel something you understand, but then equally you find factors that trouble you and you are not able to reconcile your theory. Much like the macroscopic physics versus quantum physics at a particle and subparticle level, The two both are major sciences and very important sciences, but surprisingly, the both the sciences don't sit with each other. I mean, judgments made on the Einsteinian theory of relativity and Newtonian gravitational principles don't reconcile with the quantum mechanics at a particle level. While both work beautifully at each individual level, and yet it gives a sense of comfort and confidence that you're dealing with a world that you can reasonably predict. So the many of these factors, one is to macro as well as micro, which are both evolving, and therefore keeping a mind open and ability to integrate into a model like that standard model of physics, standard model of appreciating the business. While time to time, standard model will give you not very good answers, though even if it serves your interest for a very long period of time. Therefore, you retweak and recreate the model. That is the game.
Thank you so much, sir, for such a comprehensive answer. So, moving to the second question, it's on the opportunity size or the industry size. You've always mentioned, that future opportunity size is one of the most critical points to take a look at in the business, which eventually compounds profits for a long period of time. So, we just wanted to understand how you go about thinking when it comes to analyzing opportunity size of any particular industry, sir. Which parameters should we, as budding investors, should take a look at while we are trying to judge that?
You see, yeah, different stocks for different times. Uh, in last several years, if you see, great thrust and attention in this country has been given on the infrastructure. Therefore, whether you talk about ports or airports, roads, whether you talk about digital embrace of all of these, Gati Shakti project, whether you talk about logistics, centralization of logistics, whether you talk about energy and greening energy, energy equipment, capital goods, many of these businesses have acquired a huge amount of traction because there is the focus and attention on that area. And you realize that these are fundamental building blocks for the strength of the economy on a sustainable basis. While earlier, for a long period of time, the political economy was focused much more on the political part rather than the economics part. And therefore, political economy of the previous time was much more focused on subsidies and benefits and trivialization of all of these in order to remain in power and in order to remain get the votes, not really to build the capability of the economy. These factors now really give a powerful wings to the opportunity in all of these areas. Railways has been there. Railways, I think, was set up in this country in 1853. But after some 170 years, when you are seeing the thrust on the railway and rejuvenating it and creating multifarious opportunities, whether the signaling system, whether the braking system, whether the anti-avoidance kavach system for accidents avoidance, whether the comfort and the pleasure of the travelers, safety, hygiene, uh, good coaches with a elegant design, speed, various other things are undergoing glasnost kind of changes. And therefore, railway related businesses have acquired a great opportunity. Similarly, defense, when you adopted Atmanirbhar from an unfortunate title of the biggest importer in the world in defense all along, which is not a good take to wear actually, we have slowly but clearly emerging to be more and more deeper in technology in various areas of defense, but greater output not only to satisfy within, but also to export. And therefore, opportunities get shaped up depending upon many such contexts. You have a 140 crore population, and therefore opportunity for consumption is enormous. But whether it is consumption of now merely atta or soap or shampoo, or rather more aspirational, products, whether air conditioning at home, whether the higher end washing machine at home, or higher end fridge at home, or a better car, which is why Maruti 800, which was the stapling of the Maruti success for decades, is no longer a best-selling vehicle because people have become more aspirational. Therefore, consumption will grow, but which shade of consumption will grow? One is to judge it in the context of what are the aspirations of people, how they are growing their income, what is their thought process, and how things are changing rapidly. And all of these, whether social factors, economic factors, global changes, trends, understanding of how people revise and rethink their own taste. Many of these things, what government does, the actions of the policy planners, actions of the entrepreneurs to seize the opportunity and build businesses, all these are emanating out of what others do outside you, and what you understand and analyze is likely to prevail in a bigger way. Therefore, if Unilever did well for you, Hindustan Lever did well for you at a particular point of time, there is no guarantee that it will continue to do well. Because if they are able to address only the old opportunity without creating new opportunities, the rate of growth will suffer. And therefore, the valuation has to suffer. And therefore, the question about what price becomes relevant and attractive also comes into the focus very quickly. So there is no straightforward answer, but it is a constantly evolving kaleidoscope, many pieces within the kaleidoscope. As you jiggle them around, a new design emerges. And as you evaluate many factors around, a new understanding of size of opportunity emerges.
Thank you so much, sir. So moving to the third question, sir, can we get like, I know it's already 7 minutes more than what we had budgeted initially, but could we get till 12:30 or 12:35, sir?
Yeah, sure.
Thank you so much, sir. I'll try to ration out the questions whichever way I can, sir. So the next question which we had was on dilutive growth. So you've always discussed how it is disastrous for wealth creation, sir. So if you can please elaborate a bit more, when a company goes for equity dilution, what parameters do you analyze when you come to a conclusion that whether the equity dilution is authentic or it's gonna go the other way around?
Capital dilution usually is problematic. Doesn't have to be always, but probability is very high, barring limited number of businesses and limited number of situations where dilution may be warranted and necessary and value accretive. Most other instances indicate dilution is a source of destruction. Historical examination of these also will bear that out. Typically, dilution may be called for when businesses are basically capital intensive, and therefore they need more and more dollops of capital just to sustain themselves or to grow. More often than not, that dilution will come with diminishing or value diminishing kind of the capital efficiency. Therefore, it is not merely the problem about raising the capital, but usually large dollops of capital raise will result in capital efficiency either remaining static, most likely actually declining or diminishing below acceptable level. And that is basically a very important factor for the value creation. Typically, also a third factor, more dilution may at times be prompted by the greed because markets may be helpful, markets may be generous, and you just want to take an advantage. You don't really need capital, but the character of management may come into the play and may dilute simply because it may be convenient. to raise that capital at a good price, even if it is not needed. Now, that goes against capital allocation, which is one of the key principles of the value creation. Also, dilution usually is called for taking into account the future. And no matter how good one is, but large capital dilution made today in anticipation of a future opportunity, dilution will become reality. But a value creation is an assumption. It may or may not happen. And therefore, if that future judgment goes awry, it'll be like a millstone around the neck and may not be easy to turn it around for a length of time. All of these suggest that one has to be little wary about dilution, that it is essential, it is done in a ethical way, in a right way, and it is actually for furtherance of the business or sustenance, and not merely sustenance of the business. Therefore, a dilution which will which will probably improve the capital efficiency or character of business clearly is very valuable. Dilution which is able to achieve the similar kind of capital efficiency, but an improved level of growth also is value. Dilution which is able to maintain or improve capital efficiency without diluting durability of that growth rate in the future also is a valuable idea. So there are shades of dilution where incremental capital may create for the incremental unit of capital bit more unit of value than the extent or existing model delivers. That requires a careful assessment, and if you're convinced that that is the case, then obviously you have to go. I mean, really speaking, telecom business is today becoming a consumer and very strong consumer business with a high return on capital employed and high cash flow driven business after years and decades of churn and competitive gladiator match that got played out, that today it is a game of limited number of players and high capital efficiency and high growth as well. But that required going through that muddle for a length of time. Again, that is a judgment. And therefore, wherever you feel that dilution will lead to incrementality without any sufferance, or it will lead to durability of existing good, or it will lead to not only incrementality in terms of further growth, but also improvement in the character of growth. All those decisions, even though our viewpoints are important, and where you have to take a view and take a decision. Some decisions still may not turn out to be right, but that is what investing is all about. It's not a mathematical certainty.
Thank you so much, sir. There's actually a question in conjunction to this capital allocation itself. Let me take that up. Sir, one second. So, yes, sir. So, one second. I think we'll take it up later. I don't want to waste even a 10-second right now. So the next question is on macros actually. And as India is on verge of becoming a $6 trillion economy in coming years, lots of investors are super bullish on equity markets. But we also saw a similar case in case of China, where economy broadly added $1 trillion every year around 2008 to 2013, and yet equity markets provided very negligible returns. In this context, as future investors in India's growth story, what would you advise us to do, sir? Like, what kind of mistakes should we avoid typically?
Investment returns are an outcome of variety of factors.
Okay.
Growth rate is just one of them. Quality of growth, predictability of growth, durability of growth, character of management, all of these subsume themselves into a valuation model, and the prices are then compared to that value today to derive a margin of safety or conjecture margin of hazard. China has grown phenomenally. There is no other economic example in the history. But Chinese growth has come at a lot of sacrifice, lot of compromises. Character of balance sheet is very poor. Lot of internal debt. Externally, they have lot of surplus. But for an 18 trillion economy, $54 trillion of internal debt, three times their own GDP. Externally, on their export-driven model, they were surplus. But internally, it is loaded with borrowings. Second, 39-40% of the economy is real estate, which is poor capital efficiency, again backed by unsustainable level of borrowing. And all of that is finally coming home to roost, where actually in Chinese property markets, in many places, the rates are actually rapidly falling. Therefore, it can create a very pincer-like situation for lenders. Borrowers, when they are faced with the falling property market, are actually under, and they may have a no moral dilemma to dishonor their payments. They will simply refuse to pay because it may be more financially better for them if amount saved by not paying borrowings is greater than the loss of property value that they've suffered. And all of this is with a binge of borrowing. And therefore, declining underlying asset value with a binge of borrowing makes it a pincer-like effect at both the ends. Further, if you look at the nature of governance at Chinese economy, it looks like Chinese government is determined to make a failure of the entrepreneurs and the businesses within China. You don't any longer see Jack Ma around, and you don't find whether he's going to run his businesses or not, and many other things of this kind. And therefore, Chinese markets have really no longer that powerful entrepreneurship, which is at a root of value creation, where the political power is greater than the entrepreneurial power. And therefore, Chinese markets have delivered no return even over a 10-year returns, actually negative returns. All of this is reflected, even if you take, say, 30-year comparison, where Chinese GDP has grown at 13.5%, but the value creation is a fraction of that. India's economy has grown at 8.5% in dollar nominal GDP rate, is similarly delivered output, while Chinese growth has come at a staggering discount to their growth rate. India has come at even level over the last 30 years. America has got a massive premium. 3.8% GDP growth rate for 30 years in dollar terms, nominal GDP, and 9.2% market returns in dollar terms. India 8.5 versus 8.4. China over 13.5%, but less than 2% market returns. All, when you summarize this, you realize that many more factors other than the growth are at a fulcrum. And India, last year, for the first time, has emerged as number one country in ROE in the world. America has been holding the trophy for decades. First time America has been dethroned by India to occupy the top spot in return on equity. It is some indication for future.
Thank you so much, sir. I know this just last 30 seconds, so one last question, sir. Sir, some reading recommendations that have helped you most and you'd like to recommend, so that we can go through the same.
Reading is, I don't know which is that advertisement. There can never be just one, something like that. I don't exactly recollect which one is that advertisement. Like Buffett said, it is a harem with thousands of beauties around, and an over impulse guy can run amok into that harem. So there is so much to read and so much of phenomenal stuff to read all around, whether in spirituality, whether in physics, whether in space, or whether in economics, whether in finance, whether in investment or in literature. I mean, mm, despite I, on an average, reading about 4 to 5 hours on books and about 4 to 5 hours of other reading, I never feel that it is reaching any saturation point or a satiation point. The price value equation of reading is so phenomenal. You pay a few hundred rupees, and all that you get uh, by paying that petty sum of few hundred rupees, you get wealth of knowledge and insight and information and understanding that the author may culled out over a lifetime of work. And therefore those very crystallized understanding, which is phenomenal source of grand revelation within, apoplectic kind of revelation within. Price to be paid for that is virtually nothing. Therefore, price value equation of buying a book is, in my opinion, infinity of an infinity of an infinity. But how do I really put just a few names? That would be like saying that there is only one beauty in the world, or there is only one good movie in a world, or only five good movies in a world, or five good poems in the world. If I have to give, I can give you hundreds in each field. But giving two, three of them will be getting carried away, and by saying that only these rather than the others, which in my opinion, it causes an intellectual dissonance within me, honestly speaking. But I can give you names if you insist upon, and I can put out various names.
I think we wouldn't want to put you in that position, sir. I think the next question was a piece of advice to this batch of candidates, and I think learning is one something which you have inspired all of us to engage into, sir. Thank you so much, sir, for taking out time. It is genuinely an amazing experience for us to host you. It was a very big honor for us to learn from you, sir, and we hope you give us similar opportunity in future to host you again, sir, and to learn from you again.
No, no, learning is forever. Learning is interactive, and learning knows no boundary of age. So I learn from many of you, many of my colleagues, many of others whom I know, whom I don't know, but through a derived books or others, I learn from them. I met with Buffett 4 or 5 times, Charlie Munger some 3 or 4 times. But even if I have not met with Phil Fisher, but I learned from him about various things that he had to share. Likewise, we all learn from each other. So it is mutual, it is interactive, and never ever think that I only have to impart. I'm equally hungry and keen to get the inputs from any one of you at any point of time.
Thank you, sir. And last but not least, a huge thanks to Amay Cheda, our alumni, for making this happen. Thank you so much, Amay, for coordinating with Bharat, sir. Thank you
Thank
so
you
much,
so much.
Bharat, sir. It was genuinely a privilege.